Breaking developments are emerging for Canadian homeowners, particularly for seniors who depend on fixed retirement incomes to cover their monthly expenses. Significant property tax reforms scheduled to take effect in 2026 could potentially cost thousands of Canadians substantial sums if they fail to prepare adequately. Whether individuals own their residence outright, continue making mortgage payments, generate supplemental income through rental arrangements, or maintain real estate holdings through family trusts or corporate structures, these regulatory shifts may directly influence their financial stability. This comprehensive analysis examines precisely what is changing, identifies those facing the greatest exposure, and outlines concrete measures Canadians can implement immediately to protect their retirement resources and preserve long-term financial well-being. For countless Canadian seniors, the family home represents the single most valuable asset in their portfolio. Following decades of mortgage obligations, ongoing maintenance requirements, and steadily escalating living expenses, many retirees naturally anticipate that housing costs will stabilize once they exit the workforce. However, 2026 appears poised to deliver sharp increases in property-related expenditures across several provinces and under various federal regulations. For those relying primarily on Canada Pension Plan benefits, old age security payments, and perhaps modest workplace pension distributions, even incremental increases of several $100s monthly can generate considerable financial pressure. Unexpected tax obligations reaching into the thousands could force difficult choices regarding savings accounts, investment portfolios, or even continued residence in the family home. Provincial and municipal reassessments of property valuations constitute one of the most pressing concerns facing Canadian homeowners. Property taxation throughout Canada relies on assessed valuations rather than original purchase prices from decades past. Across numerous regions, particularly major metropolitan centers, residential property values experienced dramatic appreciation over recent years. Although market conditions have moderated somewhat, assessment authorities continue updating property valuations to reflect those previous increases. When assessed values rise substantially, property tax obligations correspondingly increase even when municipal tax rates remain unchanged. Senior homeowners who purchased properties during the 1980s or 1990s frequently discover that current assessed valuations exceed original acquisition costs by factors of 5 or even 10. While such appreciation appears advantageous from a net worth perspective, it simultaneously generates elevated annual tax responsibilities. Provinces including British Columbia and Ontario conduct reassessment cycles and annual updates that can produce consistent increases in tax obligations. Alberta and other provincial jurisdictions face municipal tax pressures and budgetary adjustments that similarly drive higher property tax bills, especially when local governments confront deficit situations or infrastructure funding demands. Understanding the revenue-driven nature of property taxation systems proves essential for homeowners attempting to anticipate future obligations. Municipal governments determine total revenue requirements necessary for operations, then apply appropriate tax rates across assessed property valuations to collect required amounts. When individual property assessments increase at rates exceeding average appreciation throughout the jurisdiction, those particular homeowners absorb disproportionately larger shares of overall tax burdens. This mechanism catches many property owners unprepared. Homeowners frequently assume that broadly rising valuations will produce neutral impacts across all properties. However, practical application of assessment methodologies does not consistently deliver such outcomes. Federal enforcement of the Underused Housing Tax presents another significant concern entering 2026. Although originally designed to address non-resident ownership and vacant property situations, filing requirements under this legislation have captured numerous Canadian residents, particularly those maintaining property through corporate entities, partnership arrangements, or trust structures. Even when taxpayers owe nothing under the program, annual return filing may nonetheless be mandatory. Failure to submit required documentation can trigger penalties commencing at $5,000 for individual filers and $10,000 for corporate entities. Seniors who previously transferred property into family trusts for estate planning purposes or who maintain rental holdings within small corporations for tax efficiency purposes must pay particular attention to these requirements. Many retirees established such structures years ago based on professional guidance available at that time. However, new reporting obligations have introduced compliance risks that many property owners have not adequately addressed. In numerous instances, individuals incorrectly assumed exemption from filing requirements and submitted nothing. As federal enforcement intensifies, accumulated penalties and interest charges could rapidly compound into substantial obligations. Short-term rental income faces increasingly rigorous regulatory oversight as authorities tighten compliance monitoring. Some seniors supplement retirement income by renting basement suites or periodically listing portions of their properties on digital platforms such as Airbnb. Under federal taxation provisions, when gross revenues from short-term rental activities exceed $30,000 across 4 consecutive calendar quarters, registration for goods and services tax or harmonized sales tax becomes mandatory. Furthermore, recent federal measures deny expense deductions when rental operations fail to comply with applicable local licensing requirements. This regulatory change means rental income could become fully taxable without offsetting expense claims, substantially increasing overall tax liability for affected property owners. Municipal reclassification of properties represents an additional concern for certain homeowners. When residences primarily serve short-term rental purposes, municipalities may reclassify such properties as commercial holdings for taxation purposes. Commercial property tax rates typically far exceed residential rates. Seniors who initiated occasional rental activities to manage rising living expenses could face unexpected reclassification decisions that dramatically alter annual property expenses. Capital gains regulations also factor significantly into 2026 financial planning. Although the principal residence exemption remains among the most valuable tax protections available to Canadian homeowners, rules governing changes of use and investment property holdings demand careful consideration. Seniors who previously rented portions of their homes or converted rental properties back to personal use may encounter deemed disposition provisions, triggering capital gains reporting requirements. Additionally, increases to capital gains inclusion rates for higher value property dispositions mean that selling cottages or investment properties could generate larger tax obligations than historical norms would suggest. Many retirees contemplate downsizing to access accumulated equity and reduce ongoing maintenance burdens. However, before listing properties for sale, understanding complete tax implications proves essential. While appreciation on properly designated principal residences generally qualifies for exemption, secondary properties receive no such preferential treatment. Without careful advance planning, sale proceeds could elevate taxable income substantially in particular years, potentially triggering old age security benefit clawbacks and increasing overall tax exposure. The Old Age Security Recovery Tax demands particular attention from seniors anticipating higher income years. When net income exceeds established annual thresholds, portions of old age security benefits become repayable. Large capital gains realizations or unexpected rental income spikes could push income beyond those thresholds. Consequently, property decisions affect not only direct tax obligations, but also government benefit entitlements that many seniors depend upon for essential living expenses. Provincial relief programs may offer assistance to seniors struggling with escalating property tax obligations. Several provinces administer property tax deferral programs specifically designed for senior homeowners, allowing tax obligations to be postponed until properties are sold or transferred. Other jurisdictions provide homeowner grants or rebates linked to income thresholds. Researching programs specific to particular provinces and municipalities remains important because eligibility criteria vary considerably across jurisdictions. Appealing property assessments constitutes another option when homeowners believe valuations exceed fair market levels. Assessment notices typically specify deadlines for initiating appeals. When comparable properties in surrounding areas sell for amounts below assessed valuations, grounds for requesting formal reviews may exist. Appeal processes require appropriate documentation and careful attention to procedural timelines, but successful appeals can meaningfully reduce annual tax obligations for affected homeowners. Estate planning considerations intersect directly with property tax changes affecting Canadian families. Seniors intending to leave properties to children or grandchildren should understand how probate procedures, capital gains taxation, and municipal tax obligations may affect estate values. In certain circumstances, transferring property before death generates immediate tax consequences. In other situations, holding property until death triggers deemed disposition rules. Professional guidance proves critical in these complex situations to avoid unintended financial burdens falling upon intended beneficiaries. Foreign buyer legislation and its evolving regulatory framework may affect certain senior homeowners. While most Canadian retirees hold citizenship or permanent resident status, some may have spouses maintaining different immigration classifications or may contemplate property transfers involving non-resident family members. Violations of foreign ownership restrictions can result in severe penalties, potentially including mandatory property sales. Inflationary pressures compound property tax challenges facing fixed-income seniors. Even when tax rates remain stable, rising utility costs, insurance premiums, and maintenance expenses increase total homeownership expenditures. Senior citizens living on fixed incomes often experience these increases more acutely because benefit adjustments may not fully compensate for rising expense levels across all categories. Preparation remains the most effective response to these evolving challenges. First, carefully review the most recent property assessment notice received. Compare assessed valuations to recent sale prices of comparable homes throughout the immediate area. When assessed values appear significantly elevated relative to market evidence, explore available appeal procedures. Second, confirm whether any filing obligations exist under federal housing tax provisions, particularly when property is held through trust or corporate structures. Third, evaluate all rental activities to verify compliance with licensing requirements, goods and services tax or harmonized sales tax registration thresholds, and income reporting obligations. Consulting qualified accountants or tax professionals who specialize in real estate and senior income planning provides valuable perspective. Interactions between property income, capital gains taxation, and government benefit programs create considerable complexity. Advanced planning may permit structuring of sales or income distributions in ways that minimize overall tax exposure while preserving benefit entitlements. Downsizing decisions should incorporate comprehensive analysis of after-tax proceeds, relocation expenses, and potential benefit impacts. In certain circumstances, remaining in place with disciplined budgeting may prove financially comparable to selling and relocating. In other situations, unlocking accumulated equity may provide substantially greater flexibility for managing retirement expenses. When rising taxes create difficulty maintaining current residences, investigating senior property tax relief programs in applicable provinces deserves priority attention. Some programs permit tax deferral arrangements featuring low interest rates that ease immediate cash flow pressures. Other programs offer grants or credits calculated based on income levels. Preparation constitutes the essential message for Canadian homeowners. Property ownership remains a cornerstone of retirement security for countless Canadian seniors, yet the regulatory and fiscal landscape continues evolving. 2026 brings intensified enforcement efforts, reassessment pressures, and regulatory modifications that could generate higher annual costs for many property owners. Remaining informed and maintaining proactive approaches reduces exposure to unexpected tax obligations. Additional taxes reaching thousands of dollars are not inevitable outcomes for every Canadian homeowner. However, without adequate awareness and timely responsive actions, such outcomes remain distinctly possible. Reviewing individual circumstances, understanding applicable obligations, and obtaining professional guidance where warranted all contribute to improved outcomes. Financial security throughout retirement depends not solely on accumulated savings, but equally on effective management of changing regulatory requirements. The objective remains ensuring Canadian seniors stay informed, protected, and empowered to make sound financial decisions. Policy changes need not translate into personal financial crises. With appropriate information and careful planning, navigating 2026 confidently while safeguarding both home and retirement income remains entirely achievable. Staying informed, maintaining preparation, and continuing to monitor official announcements as governments release additional guidance throughout coming months will serve Canadian homeowners well as these significant changes take effect.